Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over ratios, look at the market ratios, look at the dollar, look at the 10-year yield, maybe look at the S&P 500, maybe throw in a couple of random things to take a look at the overall markets and what some of the drivers are, at least what people perceive to be drivers. We'll look at the housing starts. We'll look at that. So we'll dive in here. I'll give you my opinion. I'm going to start with the dollar, DXY. And what I put on here is the expansion phase of real estate. We've got the expansion phase of real estate and higher interest rates. Interest rates kind of got higher towards this back end of the real estate market, which is the back end of the commodity boom, I should say. But we had the dollar going up in the beginning phases of 98 all the way till about 2002. This is where the NASDAQ was in a bubble. It was starting to deflate. People were not running to dollar assets. And we had more loans coming into the system from the expansionary phase of real estate. Things started really kicking up. And if I were to throw something on here, let me just see. I'm throwing in housing starts. If I can find it. Starts. Got Canada's housing starts. Well, anyway, we won't throw it in. We've got the Dixie came on back down in the back half of that boom, and that's when commodities really woke up. Copper took off. A lot of different commodities took off. So I'm expecting a decline at some point of the dollar. We've broken to the downside of this strong resistance support line. We're coming up to do a retest, and then I want to see this thing roll over and get weaker. I think that's the goal, is to have a weaker dollar, and the DXY is an index where it's a dollar against other fiat currencies which are also weak. So I'm just saying historically we've seen this go down, and what I'm looking for is another weaker dollar at some point. Now, do we have to have the weaker dollar for the commodity boom? I don't think we have to. This could go sideways to higher, and we would still be in a boom so long that everyone else had greater rates of inflation than us. I think if we are in an inflationary environment with the absolute value of the dollar going down, we could have a very large commodity boom. If everywhere is massively inflationary, then I would suspect that the entire world's going to run at commodities, not just us. So it could be a very large boom in commodities based off of the currency's valuations around the world. We've got the 10-year yield. The 10-year yield, let me yank it off this. There we go. This guy's been moving on up. I'm going to zoom in a little bit and reconfigure there. We've been zooming on up. We've broken out. We could do a return move at some point. It doesn't really phase me of anything. It's going to move all around. Markets go up and down, guys. So you're going to have to take a sit on the bull, get your hand in there, and ride it. But looking back, zooming on out, we've got this long term. We've got the big peak here. We've got the long-term decline, and we're breaking that long-term decline to the upside in terms of interest rates. Interest rates, in my opinion, is what's going to force people to do things. They're going to force people to sell bonds. It's going to force people to potentially sell stocks and rotate money into commodities and precious metals. In the 1970s, which is far different than it is today, we had very high interest rates. You can see these interest rates really start to rocket higher. This was a housing boom in the 60s, 70s, and all the way up to 1980, 81. Was the biggest one of the biggest housing booms in America under increasing interest rates. So I wouldn't be so quick to say if interest rates go higher that the housing market's just going to completely crash. I don't think that's the case. We have to see things change. And the reason I'm talking about the housing market is a lot of things are based in my opinion, are based off of how many new homes are being built and the loans going against it. That puts us into an inflationary type move. And people in that age group also spend a lot of money, so the velocity of money kicks up a little bit. So that's what we're seeing. Now going to some of the ratios, because the ratios tell us relative value, and that's really where I find my valuation. Here's the CRB Index to S&P 500. This guy's bottoming out and it's starting to come up. We've broken the downtrend line. We're going to zoom in here on the dailies. And this thing looks ultra strong. It looks really good. And we're starting to see this move accelerate. So we had a consolidation period here. We broke out of this pattern to the upside. We had a little bit of a return move. Remember, markets cycle. They impulse move higher and then they cycle back down. Impulse move higher, cycle back around, and they'll just step higher. And we are at the beginning of this move. So you can tell that we've broken the downtrend line. We're coming on up. We've got even more. We've had even another kind of break here. And we continue to move higher. And this looks fantastic for the CRB Index to continue to outperform the S&P 500. And I will remain a bull on the commodities until I see the housing starts reverse. So this is on a weekly. You can tell that this is quite strong. We can zoom in and out. You can tell that this thing was coming down and down and down and down. And then it's like, boom, here we go. And this is going to last a while, guys. It's not going to be fast. Nothing in the markets is going to return. I mean, sometimes if your time frame's like a year or two, sometimes some stocks do very well in that time frame. But this is going to take some time, and we're going to see a big old move out of this, is my expectation. Here's the platinum to gold ratio. Usually when platinum outperforms gold, we are in a commodity bull market. We are in an inflationary type market. We broke this pattern. Here's the pattern. We broke it to the upside. We did a retest, and now we're looking for a move higher. We could throw a pattern on here. You can kind of throw this on here and say, okay, we broke that to the upside. We're just relaxing. And I'm suspecting that platinum's going to take a good launch at some point. And I'm not in the game of trying to figure out the exact timing. I don't care about the exact timing. The moves are going to be so big, it's not going to matter. Your opportunity cost, some people look at opportunity cost and they, oh, it's not going up, but the move's so big, it won't matter. You just have to get on the bull and ride the bull. And we've broken the downtrend line. That is what's important. We've got our breakout. We've got the return move. This is where I buy. This is where I load up for the move higher. And this is a ratio. This is the platinum to palladium ratio. Palladium is one of the largest exports of Russia. And we could see this even dive lower if there's problems in Russia and palladium production. It's something on the lines like they produce 50% of the palladium in the world. So if they have massive problems, we could see this compress and palladium could have a blow off top. So there's that. Platinum against silver, the platinum to silver ratio. We've been declining, meaning that platinum is cheaper than silver. Platinum is ultra cheap to silver. We are way down here in no man's land. It's breaking to the upside, meaning that platinum will outperform silver. And we've got this, it's gyrating back and forth right at the breakout for the platinum to silver ratio. We've got gold to silver ratio. It is still favorable for gold outperforming. It's been coming on up. I think this will be as long as the markets are coming under pressure. Once the markets kind of deflate some of this stuff away and we start hitting a little bit higher, we maintain our higher inflation rates and the interest rates start going up, I think silver is going to start to compress. But we need the markets to stabilize first because they're heading lower, in my opinion. And I think people prefer gold over silver in the beginning of the bull markets. This is the palladium to silver ratio. Looking at it, we've been just chopping sideways. with palladium. This would be silver. When this goes down, silver's outperforming palladium. I suspect that silver will outperform palladium, and this ratio will compress over time on the long-term commodity bull market. The Dow Jones Industrial Average to gold ratio, you can see this thing starting to break, and it's breaking down. We've broken to the downside. We have a new downtrend because this is broken to the downside as well. And what that looks like is you have an uptrend move. It breaks it. It does a return move, and then it breaks that low. So we have a new low, a lower high, and then now a new lower low. And this is now in a downtrend. So I would suspect that commodities and precious metals are going to outperform the stock market over time. We have the gold to oil ratio. We've been bouncing around this support line at around 1920. We got to break this to the downside and close below. 19 would be a clear break or so. For a long-term, hit the wrong button there. Sorry, guys. Sorry. It's hitting auto. A long-term break here to the downside if we're in a big old commodity boom. You can tell that we've got these type of two patterns there. There's another pattern that's developing, and I think we're going to compress it down there. This one compressed to 16. At the end of the last bull market, if I can see here, that's 2014. We got to keep going here. 2008, it compressed down to 6.5 to 1. So I'm thinking below 10 is probably where we're going to go on the ratio of the gold to oil ratio. What that means is that oil compressed against gold and got down to 6.66. Nice. 6.5. A 6.5 ratio. If gold goes nowhere, let's just say we're at like $1,900. Let's just say 2,000 and divide it by 6.5. $2,000 divided by 6.5. Oil would be at $307 at a peak. If oil were to do what it did in 2008, if it were to repeat itself. So if we were to have the same exact replication of 08, oil would go to $300 if the compression compresses the same and gold's at 2,000. I think we're going higher than that. That's me. And then the copper to gold ratio. Let's do all here. Let's auto it. We are still bouncing around right underneath its long-term trend line. I've got the break there, just wondering if this thing's going to break out. If we go to a yearly candlestick, so these are daily candlestick charts in here on a year, we've been chopping sideways the entire time. It's very similar to what it did back before the other bull market. The other bull market back here, if it decides to show itself, the other bull market back here, it chopped sideways for a while and then broke to the upside. That was in 2005 to 06, and then it kind of came back down. I suspect something very similar to this. For no rhyme or reason, I'm just expecting it, and I think copper is going to get pretty tight. Gold's going to get tight too. It'll be interesting to see what happens here, but we're right underneath this trend line. Scrolling on down, we'll just look at the S&P 500. Maybe I'll go and do another clip on the overall markets. So if we were to zoom out on the markets here, let's do logarithmic so it kind of stretches things out so it's easier to see. These are expansionary phases of real estate. A lot of these. This was an expansionary phase of real estate from 68 to like the late 80s, and then we broke out. And then we had an expansion phase here as well. So we went sideways the majority of the time for the S&P 500 under these expansionary phases of real estate. And this is where commodities and precious metals really took off. I think that we are entering we are in an expansionary phase of real estate. And what that means is another move where we're going to go sideways. We're going to chop lower to sideways over that extended period of time. It was doing this when interest rates were going higher, and then they smacked interest rates down, and this took off to the upside. But I don't. If they hold strong with higher interest rates, this will deflate and go lower. The driver of, well, we can go over to a couple commodities too. This is the lumber futures market, and it's remaining elevated. I know a lot of analysts or people who in the markets. Let's take it off the log. Like Kathy Wood, like, oh, lumber, it's coming back down. It's like, no, we are in an inflationary environment. This is going to remain elevated with elevated demand worldwide to build new homes, and we are exceeding the capacity of how much lumber they can process, and we're keeping elevated prices. I think that will continue. I'm sure it's going to bounce up and down, but it's going to remain elevated. Nickel is remaining elevated. It is broken to the upside of this squeezing up. Had a nice little break there, and I think we're going to remain elevated for nickel and potentially go higher. Nickel is a input for electric vehicle batteries. And then we've got palladium for the dollar amount there. I suspect that this goes lower over time, even though we could have a spike, depending on the Russian deal. We've got cocoa futures, they're down a little bit on the weekly, but we are lining up these massive patterns from 1980 all the way forward. It's like we've had this large disinflationary lower interest rate environment, and this could all reverse to the upside. That is what this chart is telling me, is that from 1980 or the 1970s, same with this one, 1980, we've broken to the upside, get this nice volatility, and we've been moving higher for wheat futures and cocoa futures. And this is soybean futures. We're breaking to the upside for soybean all the way from 1980, 1971. We had this long-term move sideways, breaking up, and then I think we're going to have a launch higher. Why do I think we're going to have a launch higher? Because natural gas prices and fertilizer costs and fuel costs and input costs, they're all going to go up. And I think yields will drop if we're not using the nutrients in the ground. And all food is sucking nutrients or minerals out of the ground, getting deposited into our food, and then us consuming it. It's basically another way of mining. You're mining minerals out of the ground and storing it in food. And here's 70s. Again, we've broken this to a new level, and then I think we're going to break this to a new level soon for corn futures. And then copper. And again, guys, this is all priced in dollars that we're looking at, and the dollar, I think, will go lower at some point. Looking at copper, we've been chopping sideways. This has been a chop fest in copper in terms of the dollar. But I suspect this will go up with time. Looking at the housing starts, I got USHST, the housing starts. Looks like we got new data here. That's good, if that is new data. We're at 1.65 million, and we're still above the average. If that is new data. I'm going to look right now, guys. Housing starts Fred, because this is important to see what's going on here. January 2022 was updated February 17th. We got new data here. We had 1.638 million is what we had, which is still a very good number, and it's still above the average. We're going to have to watch it and see what happens. Now, let's see if they updated the housing permits. This is the first time I've seen this, guys. Red housing permits. We're at 1.9 million. Wow. That's good. Updated February 17th. 1.9 million. 1.899. So the permits are going up, and the housing starts are remaining elevated. Now, what does this mean? It means that we're building more new homes, which means more new loans against those homes. So it's very inflationary to have a boom in housing starts, new homes being built and new loans being put against it. Our permits are continuing to go higher at a very high rate, and our completions, which is our housing starts, they may be stuck where they're at because of shortages, supply chain shortages. It's difficult. It's difficult to complete a house, from what I understand, what the articles I've read, to complete them. So we could get stuck, and house prices may remain very elevated or continue to rocket higher with this large supply-demand imbalance. So I think that's the driver of everything. That's where the inflation's coming from, is from the housing starts and the loans against those new homes. 60% of commercial bank lending is against residential real estate. So that's 60% of the money supply growth and whatnot. Having higher home prices, especially with low interest rates, also spurs people to refinance. I think that will decline with time, and I don't think that's a huge driver. But some people do take equity out of their house, expanding the money supply and getting loans against vehicles and whatnot to buy cars and whatever else. So that also contributes to the expansionary phase, or the expansion of credit. I'll end it there, guys. I'll do an overall market update coming up probably maybe tomorrow or something like that, and look at a bunch of different stocks and see how they're holding up. But give me a thumbs up for the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.